Joining me now, Steve Whiting is Chief Investment Strategist at Citi Private Bank, and David Tinsley is Senior Economist, Bank of America Institute. It's great to have you both here.
Thank you.
David, let me just start with you because you guys can kind of unpack this a little bit. How much of the spending we've seen in recent months, broadly speaking, is just price increases?
Well, some of it's that in that retail has been boosted by gasoline prices. But in our data, when you look across the piece, you see very strong service sector spending as well. So, and when you look, really broadly at the sort of balance sheet of the consumer, it's in pretty good shape. So I'd say some, but certainly not all.
We've spoke with your colleague Liz, who says, and there's a huge debate about this, is the consumer's kind of like excess savings or dry powder, is it running out and we're about to face this trifecta of student loan repayments and higher gasoline prices and all, higher borrowing rates? Or are we still in a better position than we might have been a few years ago, supported by real wage gains? So what do you guys see happening there?
Well, what we're seeing is that on the deposit side, they're up about 30-40% across all income cohorts.
Amazing.
So that looks pretty solid. On credit cards, people aren't tapping their cards relative to their limits as much as they were in 2019. The utilisation rates are still lower. So, in the round, we think there's dry powder still in the consumer. There are a few headwinds, student loans, as you say, but all manageable, I think, over the next 6 months or so.
How does that jibe, Steve, with kind of your view on things and what you think is going on with the consumer?
So, look, it doesn't really lend itself to a complete bust or boom view. It looks like a deceleration. 3 years ago, we had an absolute depression in services employment. And services employment rarely falls very much, even in recessions.
Right, very steady.
And so to get all of that back is actually helping a lot. It's actually working through some of the problems we have in the goods sector. We have manufacturing recessions, trade recessions, and we're getting inventories down because of this persistent strength in services hiring. Now, the whole thing is growing half as fast as it did a year ago, and it doesn't just stop there. It'll probably continue to decelerate with some of these headwinds, but it's getting us to a place where we just are not going to have that collapse that happens when you have a full-blown drop in employment of serious magnitude.
More of a cyclical thing. So when you look, jobless claims, okay, last week we thought, well, maybe distorted by, Labor Day holiday, they were very low. This week, again, very low. It doesn't seem like a seasonal issue. It seems like a cyclical tell. And do you think that this ongoing rebound in services is still why? How much longer does that have to go?
The claims data, again, really high quality data. There's no samples, everything. We love this data, but it's not showing the entire picture. When you take a look at job openings, have fallen by 2.6 million.
Right.
And again, the net pace of hiring is decelerating. So the net firing or people being able to quickly find another job, it's still painting a picture of stability overall.
So, David, if we kind of go, okay, well, then maybe I can understand why a camp like Goldman's goes, okay, recession odds are down to just 15% in the next 12 months. I'm amazed to hear you say that credit card utilization rates aren't at the levels they were in 2019, at the same time as we've seen delinquency levels reapproaching where we were back then, and rates kind of on a nominal basis are so much higher.
Yeah, I mean, behind all of this is really the labour market strength. So when you look at the lower income part of the distribution, wage growth has been at the strongest, above that of middle and higher income. So I think, that's driving, in a sense, the ability to borrow and the spending picture. So, there are corners of households, the market, where people are feeling some stress vis-a-vis, borrowing, etc. But it's minor, I think, really, ultimately.
For now. So, Steve, the final question then, as it comes down to the Fed, which is not expected to hike this month. I don't know what your expectation is if there's, maybe another hike in November when they start cutting. How does this shake out for them?
So they've done a lot. And they're doing more with quantitative tightening.
Yeah.
Just take a look. Again, it not only is the Fed reducing its Treasury holdings, but foreign central banks appear to be doing the same thing. And if you apply some lags here and the fact that employment growth is decelerating, you could say, well, 187,000 jobs, that's still too many. Well, where is it headed?
Yeah.
And I think if you look at next year, you're going to say the Federal Reserve is probably going to back off of sort of a really ultra-tight monetary policy. It's not going to give us zero rates again. But the whole point is they don't want to. We shouldn't actually need a collapse this few years after a deep recession.
All right, gentlemen, thanks. We'll leave it there for now. Steve Whiting and David Tinsley with stocks in a better mood these days, that's for sure.